Welcome to another episode of Tank Talks, your personal think tank for all things startups and venture capital. I'm your host, Matt Cohen, founder and managing partner at Gabriel Ventures. This week's episode is a conversation I had with Jonathan Tower, managing partner at Catapult VC, a cross-border venture capital platform which specializes in investing in emerging tech hubs outside of Silicon Valley. Jonathan has deployed more than $220 million in more than 50 companies, including Jet.com, Dollar Shave Club, and Freshly. On today's talk, we discuss Jonathan's views of the Series A gap and the rise of seed stage investing. We dig into the knock-on effects of more capital pouring into seed stage startups and how seed funds should think about strategy drift when it comes to investing in later stage rounds. We chat about the insane valuations coming out of YC Demo Day on pre-revenue companies and how he thinks it will all end. Finally, we asked Jonathan to share Catapult's worldview on emerging tech ecosystems outside of Silicon Valley and why he is so bullish on them. Now let's get into this week's chat with Jonathan Tower from Catapult VC. Thanks for joining us, Jonathan.
Yeah, great to be here.
Let's kick things off with the recent rush into the emerging manager and seed stage venture landscape. Given you've been investing in technology companies for over 20 years, what do you think has been the biggest reason why so many seed stage investors have emerged in the last decade?
You know, it's hard to say if there's one dominant reason. I'd say it's a couple of reasons that come to mind. I think the obvious reason, what we've seen over the last 15 years, is just the overall costs of launching a startup have really plummeted. We're living in, obviously, a world of AWS and off-prem solutions. And so, what would normally take maybe 5 or 10 million of capital 15 years ago to get to a level of traction and validation, I think you can do with a few $100,000 now. So it's really changed the dynamics and the capital requirements of spinning up companies. I think the next reason is really the angel investing ecosystem has really become a lot more institutionalized. And so you've seen, tremendous amount of liquidity events for thousands of early employees of great technology companies. And that's really created an entire generation of angel investors, right? We hear a lot about the PayPal mafia, and that's very accurate, but there's also a Google mafia and a Facebook mafia and a Dropbox mafia. And these are also, examples of companies that had great outcomes. And the diaspora of the people that work there have had personal liquidity, and they want to invest back in the ecosystem. They want to get into angel investing, and that's really created a tremendous crop of new investors that are investing at that stage. And I think the third theme I would say is, and this is a broader conversation around where the VC ecosystem is going, but the way we think about it is we're sort of in VC 3.0. And what I mean by that is, if you think of sort of VC 1.0, that was sort of the legacy firm model from the 1960s to the late 1990s, the larger firms, the Sand Hill Road firms, the firms that were structured like law firms, quite frankly, right? Where you had partners and junior partners and associates, and you kind of worked your way up through the ranks. A lot of those partners came out of investment banking or management consulting, not necessarily operating roles. And then you had this changing of the guard maybe 15 or so years ago during the Web 2.0 days. So we call that sort of VC 2.0. And this is sort of the young Turks of investments, young Turk firms, or first round capitals, the True Ventures, the Shastas, the people like that sort of came out of the woodwork. Maybe they spun out of other firms, and they became quite dominant over a short period of time. And that sort of showed that the old school model of venture was not necessarily the only way to play the game. And I think now we're in 3.0, this sort of world of solo GPs and nano funds and rolling funds and angelless syndicates. And I think it's really changing the dynamics of angels. I think it's a variety of those reasons that I think is bringing us to this place today where we have so many new firms deploying assets at this stage.
It sounds like the democratization of access to information and capital has kind of rippled its way through the entire ecosystem, but it's also accelerated a lot in the last 5-10 years. And we've seen a lot of people kind of jam themselves into this seed and Series A stage of venture capital. However, we've also seen a little bit of a bifurcation in the later stage growth equity side of venture capital. You've got firms like Pipe and Clearbank now who are helping support the more established startups. So have you given any thought to what the sort of Series B or later stage growth funds are in for with this huge influx of capital at the early stage?
I think it's a tough spot, to be quite honest with you. And I referenced this a bit in my last post, where we have this barbell effect in venture, where we have a tremendous amount of fairly new capital being deployed in the seed stage and lots of new players coming into the later stage. And then you have this sort of, I don't want to call it a no man's land, but a market in the Series B and Series C level where you don't have quite as many firms deploying capital there. And I would make the case that a lot of that capital is somewhat undifferentiated. And so I think it's tougher for firms that are at the Series B and Series C level. And there is a lot of pressure from later stage funds that generally are at the sort of pre-IPO stage when they like to invest, that are coming up market and getting into earlier stage deals because they feel that's necessary for them to really get access to those great companies. And I think in many cases, there's less desire to shop high quality deals from Series A investors, right? So if you're a seed investor or Series A fund, very often in the old days, you would just naturally work with that company, get them to a level when they can raise a Series B, and then you sort of bring them to market and sort of kick them over to your friends in the Series B, Series C level investment game. I think that's becoming more difficult too, because a lot of those firms are raising their own continuity funds or opportunity funds where they can continue to deploy capital in their best companies. And so the necessity of going to market to shop a company for additional capital with new investors that only invest at Series B or Series C is not as compelling now, because a lot of these firms are sort of keeping these deals in the family, so to speak. So I think those are some general pressures that I see at that level.
Yeah, it feels like everyone's going sort of downstream or earlier. Like the public funds became later stage pre-IPO funds. The later stage pre-IPO funds became growth stage funds. And then the growth stage funds are now becoming early stage funds, and so on and so forth. But is there anything that scares you or concerns you about the recent rush into venture capital and the alternative investment class right now?
Yeah, I mean, there are some things. I think we're seeing some froth at every stage of the market at this point. In the later stage, as I've alluded to before, you have a lot of fairly new platforms that are investing at that stage. You're seeing lots of firms and LPs that would typically just be investing in funds going direct, and that's creating more competition. So I think there are some issues around that. And I think there's some concerns, frankly, at the seed stage. We have so many new platforms spinning up. And while I'm very heartened by all the innovation and some of the great new investors out there, there are a lot of investors that have never seen a bad market, right? Let's bear in mind, we've had basically a 12-year boom market for tech, really since the global financial crisis. And there are a lot of new platforms that spun up in that time, thousands actually, that have never really invested through 2001 to 2004 or 2008 to 2010. And so we get some concern that when we do hit a serious air pocket, not just a temporary pause, do those investors have the ability to really be helpful and help companies get through a very difficult environment? So those are concerns that I have, and I think those are concerns that LPs have as well.
Yeah, and we could go on and on about some of the frothiness in the market, but let's hone in on something that we want to talk about today, which was related to your recent blog post discussing the Series A gap and how more capital has been flowing into seed stage startups, which is a good thing. However, you stated how more capital flowing into the seed stage has created more startups getting funded, which is a bad thing. Can you explain what you mean by that?
Yeah, and I was being a little bit inelegant in that remark. What I was really alluding to was trying to paraphrase the old joke about smartphones and smart technology from some years ago. And, the joke was one of the great things about smartphones is that you're always reachable. And one of the worst things about smartphones is that you're always reachable, right? And I think, the point is that all venture investors at the end of the day, they want their capital to be channeled into going after the incumbents. And I think one concern is that we've had so much capital being deployed, especially at the early stage, that maybe we have funded dozens of companies in a sector or in a segment when maybe a dozen or less would be actually a more optimal number. And, if you remember a couple of years ago, Peter Thiel, sort of in a bit of a harbinger type comment said, one of the concerns is that so much money in venture capital, specifically in Silicon Valley, has really indirectly gone into the pockets of slumlords and landlords and so forth. And his point was, Silicon Valley was so expensive to operate, and so much venture capital had been raised that a lot of it was really being sort of siphoned off to paying for overpriced office space and embedded into the salaries of engineers that were spending $5,000 a month for a studio in San Francisco. So his point was that is not the best use of capital. And I guess using that, that point that Peter was making I was saying that, although, the notion of a pure capitalist notion or a pure economist notion may be saying, hey, let 1,000 flowers bloom, isn't more competition always better? I would say, the notion of creative destruction can also mean capital destruction. And so do we really want to have so much capital sort of burning up with startups fighting one another and not training their weaponry and their firepower on the incumbents, which is ultimately what we all want to do, build great companies that can define billion-dollar markets and then hopefully go after, lazy incumbents that we always want to target and really change the industry. And so the more of this capital gets burned up because startups are fighting with each other for talent, for resources, for service providers, for office space, is not capital being deployed into ultimately what we want is to build leading edge companies.
I couldn't agree more. I think the more companies are getting funded, on the surface looks like a good thing. But if you really dig deep, how much innovation is really happening at these B2B SaaS companies, right? Are they just making their products 5% better, but they're spending 95% of the money they're raising towards Facebook and, SEO ads? What is the innovation that is actually coming out of the dollars being burnt here? And one of the things you mentioned is, recruiting, right? We're starting to see knock-on effects of more capital pouring into seed stage startups, and it's impacting the ones that are more capital efficient when it comes to recruiting. I mean, even in our own portfolio at Ripple, we are seeing more capital efficient startups struggle to retain talent as more cash-rich startups are poaching their employees away for more money, even though their product or their revenue is far lower. So how do you recommend startups defend themselves against these problems?
Yeah, it's really tricky. It's a problem I have in my portfolio. I think every venture investor has these issues. It's unfortunate because if you are a capital efficient business, you are in some way being penalized indirectly because, again, as I mentioned before, you're competing for talent with other startups in your space or even completely in different areas of the technology landscape. At the end of the day, startups need to know what the hiring market is in which they operate. No man is an island, no company is an island. The price of talent will affect your ability to retain and attract talent, quite frankly. And so, one of the things that we do and the exercise that we have with our portfolio companies is really try to get them to answer the big, hairy, existential questions around, what is the offering that you have? How compelling are you being to potential hires? And really understand who are the candidates that you're targeting. Are these candidates evaluating an offer from you versus an offer from another, small seed-backed startup, or are they looking at offers from Google and Amazon and Facebook, right? Very different set of circumstances in some ways. And so we really ask them to crisply define what their value proposition is. Why would they be attractive to a great hire that's also attractive to many other employers? Obviously, when you're a startup, you can leverage those strengths. You're offering upside. You're offering the chance to impact the culture of a small firm, which you clearly can't do if you're joining a 30,000 person organization in the same way. You're getting on the ground floor. You're changing the world. All those usual things you want to make sure you're emphasizing in your offering. But I think it's really important to understand who you're targeting and what you're baiting your hook with, as we say. And one of the things that we always try to impress upon founders is, if you're incentivizing somebody purely on cash and comp, you can't be exactly surprised if in a year from now they get lured away with somebody's offering more cash and comp, right? That's what you hooked your candidate with. You need to offer a much more full package of the attributes of working for you, hopefully qualitative metrics, not just quantitative ones. And so, but your point is absolutely correct. I mean, it is very challenging to be competitive in this environment when you have so many companies out there fighting for great engineering talent or great talent in general. And if you don't have a tremendous balance sheet because you haven't raised tons of capital, you can get a disadvantage.
Yeah, I think the only equalizer I can envision coming out of the pandemic is the remote first approach to recruiting, where people who are living in Boise, Idaho are okay coming to work for a seed stage startup. And even if they do get offered more money, but they don't see an alignment in vision or mission with that newer company that's trying to poach them, then you have a better chance of keeping those people. But if you're all fighting for somebody located in New York or Toronto or Vancouver, and you're going up against every seed stage startup plus Amazon and Google, it becomes a lot more difficult. So you're saying you got to really hone in on what those qualitative aspects are about your business to keep people around longer.
I think that's a good approximation.
Gotcha. Yeah, it's definitely a problem, and I don't think it's going away, but I'm a little happy to hear that I'm not the only one facing it with our portfolio companies. So as more companies are becoming more capital efficient, the need for larger rounds of early stage capital aren't always required, which is great for seed stage funds like Ripple and yourselves to invest in startups that are doing, let's say, over $1 million of ARR and only needs, let's say, 3 to 5 million to get to $5 million in ARR and then continue to double from that. So how has the seed to early Series A rounds changed, in your opinion, over the last few years?
Yeah, I mean, in so many different ways, we could do a whole post on this. But, I think at the end of the day, companies have much more options now to bypass traditional VC, right? You have many other sources of capital. You have many other ways to structure that capital. As I mentioned earlier, companies are getting a lot further with less capital than they did in the past. Obviously, it's dependent on the sector and how capital intensive your business is. But broadly across technology, you have many more companies that can really stretch those dollars very effectively. And you're seeing the movement in the venture ecosystem in response to this. A lot of Series A firms are moving upstream to get in those companies earlier, rather than getting boxed out and then not getting allocations in hotly competitive companies. And so that's changing where a lot of these firms are playing along the spectrum of stages. And I think you're seeing valuations spiking in response to the amount of capital in the system and how aggressive firms are becoming. And so I think all those things are creating this sort of a little bit of a frothy dynamic right now where, the rules that applied 5-10 years ago are a little bit antiquated at this point.
I mean, let's go to the epicenter of frothiness for a second. We're seeing YC demo day companies with companies doing barely any revenue being done at $20 to $30 million cap safe notes. And investors are rushing into these rounds. Can you please explain this to us and how this will all end?
YC is in a bit of a league of their own. They've really done an amazing job in terms of building their brand, building their track record, and, really mastering the demo day format, if you will. They clearly were not the first, but they've really sort of gotten into a level of the stage where it's just a very, very powerful and popular format. And I think the other reason is they serve as a form of curation for investors, right? Investors from across the world, thousands of investors, can sit in and dial in on a demo day, and they can see 300 companies in 2 days. And so even if they don't write one seed check in that particular batch, it's a great barometer for what founders are working on, right? What are the problems that founders are trying to address at this moment in time? And I think, these types of demo day events are very good for that. I think the other side of the coin, and again, this is a little controversial, but, there's just a lot of follower firms now. There are a lot of venture platforms and investors whose primary business model is, I'll state it very plainly. They'll say, we don't lead, we don't issue term sheets, we don't take board seats, we don't ask for special considerations. We just want to be in all the deals that Sequoia leads, period, full stop, or Lightspeed or Excel or whoever it is. And it happens on the debt side. You see a lot of debt platforms that have a very similar thesis. They may not put it on their website, but they have a short list of a dozen or 20 firms that basically, if you're not backed by one of those firms, it's virtually impossible to get a debt facility from that particular venture debt platform. So it is a thing, and I think this creates a certain amount of froth because you have dozens of firms that are essentially following on to whatever a tier one firm is going to do. It's like having a wake behind you when you're water skiing, and that sort of wave of capital creates a halo effect for any company that comes out of YC that gets a certain syndicate of investors behind them that create that positive signal.
It's what happens when you have a 12-year bull market. This is what the frothiness ends up becoming. But I wonder if any of these investors have actually played out sort of what happens at the end of the line. Because yes, I get why, the Sequoias of the world can do these types of rounds because they're getting pref rights, they're getting liquidity rights, they're getting visibility and board seats, and they're able to maintain their positions over time. If anything, buy into their positions by the time the company goes to an IPO. But as a follow-on investor, as an angel investor, I mean, you're going to get squeezed out if things don't work out. And if things do work out, you're not going to have the return you thought you would have when the company ends up becoming billions of dollars. I mean, you could have a great return for doing nothing almost, but has anyone actually played out what that means as a venture fund in terms of how that affects your entire venture model? Because I don't think it ends well.
You're right to be concerned. I think there are dynamics at play. There's not something that you want to necessarily go to market with or put on your website, but they happen. I think part of it is a lot of it is signaling. You have a lot of firms that want to get into a marquee deal because it looks great in the website. They can market against it, and they can say, well, I was in, whatever, name your unicorn exit. Now, dig into the details, and they own 0.000001% of it. And from an LP perspective, it didn't exactly return much cash to your LPs, right? But God, it looks great in the website, and you can use that to market and say, I was an early investor in, XYZ unicorn company. So I think there's a lot of that goes on as well. And then I'd say the third dynamic behind this is, again, going back to the fact that we have had this surge of new seed funds deploying capital in the asset class. A lot of those firms are putting that capital to work really fast, partly because they need to, so they can go back to market and raise the next fund And it's not going to be enough time to have any meaningful exits for the most part. But then you can at least say, well, we've got all these really nice markups, right? We were in the deal X, Y, or Z, and we've got a nice percentage markup on the portfolio. That should prove our thesis works. Mr. or Mrs. LP, can you please back our next vehicle? So I think there's a little bit of that goes on too, a little bit of that positioning, and I think you can't ignore it.
Yeah, it sounds a bit of like window dressing, and then also just taking advantage of the liquidity in the market and also the non-standardized reporting metrics for GPs to hold them up against the same sort of class when they're shopping out their funds. But we could talk about that another time. Going back to the topic at hand on the Series A side and the gap in the market. So Series A funds are demanding more traction from startups than they have in the past. It used to be that if you hit $1 million in ARR, you could raise a Series A. And now that number feels a little less meaningless as we're seeing companies raise Series A's with, let's say, 300K in ARR, and some even have 5 million in ARR. So what is the target or the metric that startups should aim for? Is it velocity, capital efficiency, LTV to CAC ratios? What is it in your mind?
Metrics are very sector specific, right? So just looking at LTV to CAC, in one sector, it's going to be very, very different from another sector, right? What is meaningful in that particular ecosystem or that particular vertical? I think what I was referring to in the article was sort of the difference between these sort of preempted Series A deals that are very hotly competitive among venture investors and then other deals of other companies that are just trying to get their Series A done. And in some ways feel like the goalposts have moved, right? What would normally be perfectly reasonable for a Series A company to be at that level from a metrics perspective, from a traction perspective, is no longer table ante. It's not going to get the deal done. And part of it is because, and again, some of the Series A investors will admit this, they're saying, well, wait a second, 15 years ago, a typical seed round was $1 million, maybe $1.5 million. Now it's like $5 to $7 million. And so, we're going to want to see a lot more traction and validation in your business for this $7 million that you've deployed to date than we may have 15 years ago when you only had $1.5 million to put to work. Oh, and by the way, it's also a lot more capital efficient economy now. We've got a lot of these off-prem solutions, so you can build your business a lot more efficiently as opposed to 15 or so years ago. So I think that ends up being a little bit used against some of these companies that are out to market trying to raise their Series A. I think that's what I was referring to.
Got it. Yeah, that makes a lot of sense. Sometimes when we see companies that have been started in 2014 and they just got to $1 million of ARR, their metrics could look great in the last year, but you're wondering what happened over the last 4 years to get there. And there's a lot more behind the curtain that is not being shown just in that $1 million ARR number. So how should seed funds who are known for being early stage funds, who end up getting involved as a Series A lead, be considered, in your opinion, from the LP side? Like, is that strategy drift for them, or is that just taking advantage of the market?
Yeah, this is obviously controversial. I think, to be fair, some strategy drift or migration is understandable. In some cases, you can make the argument, as the investor saying, hey, we launched a seed fund to prove our concept, to prove we can access great deals, to prove we had a great nose for deals. And now that we've proven that, we want to raise a larger fund to really, double down on our winners, right? That's a reasonable argument. Most of the firms will make that. They can also make the argument that, hey, by moving downstream, it's a little less competitive. We're not competing with 500 firms, we're competing with 50 firms. And so it's easier for us to do that. So I think that's a reasonable argument to make. More cynically, I think there's also a little bit of an AUM grab here as well. It's a good excuse to raise larger funds. You can do more. You've got a bit more management fees coming in. And so I think that also is part of the dynamic. And there are some funds that I'm sure raised their seed funds really because it was a way in the door. It was a way to start the business, to get into venture, and then use that as a way to raise a larger platform as you executed on your thesis. I think for LPs, I just think it's a matter of doing your job, doing your diligence, being vocal when you see there's a clear, not very well explained strategy drift in the fund that you're backing, right? Just because you've been a successful seed investor on a $10 million platform doesn't mean you're going to be successful in a $60 million platform. And we are seeing funds spin up that fast. Funds that raised $15 million vehicle one are now out raising 85. Again, just because you've been very successful at the really micro level VC stage doesn't mean you're going to be successful later on. I think LPs should push back on that and make sure that they really understand what the strategy is behind that, and have a meeting of the minds before you partner with some of these funds to say, what is your real desire. Do you really want to be a seed fund, or are you just raising a seed fund because you think you can get it done, but you really want to be a Series B fund or A fund, in 2 or 3 fund cycles from now? Just make sure you're partnering with folks that are aligned with what you want to do, because LPs ultimately will feel a little bit of bait and switch that they got into your fund, they made the investment in the relationship, and now you're raising a very different fund, 2 fund cycles from there, and they feel like we wouldn't have done this with this particular manager if we knew this was just a way to get into a larger platform.
Yeah, I agree. I think it's also about transparency with LPs along the journey. So for us at Ripple, we did Fund 1 as a pre-seed seed fund, truly just to get in the door, but we led 80% of the deals in Fund 1. And then with Fund 2, we went out and did a kind of seed plus early Series A fund, because that's where we thought the best, value was for our investors. And we went out and have led so far every one of the deals we've done. And we were very transparent with our LPs that, look, our plan is to go out and raise a bigger Fund 3 that has the ability to do pre-seed all the way up to early Series A, but not because we just want to do it. It's because we've shown we've been able to do it. And with more capital, we can get there. So as long as I think the vision is explained along the way and you're transparent about how you're going to get there, I think that really makes sense. But if you're just a follow-on investor at seed and then you now want to go lead Series A, I think that's a world apart from what at least I've seen and what LPs are telling us.
Yeah, 100%. And I think it all comes down to the vision and how you're messaging that vision to your LPs, right? Hopefully, when you're talking about Fund 1, you've already thought through in your mind like what Fund 2, 3, 4, and 5 will look like, right? You have some sort of a vision. Hopefully, it's not so ambitious that LPs get scared, like, wait a second, you're trying to boil the ocean here. But at least you're able to say, look, if we can execute on this vision, then naturally what we think we're going to do is spin up Fund 2. It looks like this. Fund 3 looks like that. Maybe we'll do a sidecar fund to do this, because it all works under our thesis. It all works under our banner, and it's all congruent with our messaging. I think that's fine. That's perfectly reasonable, and I think LPs should ask for that. But I think when it feels haphazard and tacked on and too opportunistic, where a fund says, hey, we did a seed fund, we did okay. Hey, we're going to raise an AI fund because AI is hot. We're going to raise a VR fund because VR is in vogue, whatever the sector is, right? We're going to sort of chase heat. We're going to chase momentum. Then that's where I think LPs need to kind of tap the brakes and say, wait a second, like what's the vision here, really?
Yeah, I guess that's the difference between raising a venture fund and a venture franchise and building a platform versus just the one-off sexy funds that are in the market right now. But let's talk about Catapult for a second. I mean, you and your partners were very well-known Silicon Valley investors when you spun out to form Catapult. What possessed you and your partners to leave those well-known funds to even launch your own platform?
Yeah, I mean, it was a bunch of things. I think for us, we saw some fundamental changes afoot in venture the last few years that we were investing in, and we've all come out of well-known platforms who've been doing this for a while. And I'd say, back in sort of 2017, 2018, we really saw a realignment occurring around, I would say, sort of 4 core themes. I think first, as we've talked about on this podcast, we saw a real surge of new capital pouring into Silicon Valley. And not surprisingly, what that was doing to the ecosystem from a cost perspective, from a hiring perspective, just from overall valuations, everything was really kind of getting a little bit wonky. And it was, quite frankly, very, very difficult to invest and get the returns and get the economics that you needed to make it make sense to be playing that game. So we saw that happening. So the second theme that we noticed was we looked back in our track record. We looked back in the successes that we had and where we were getting the most bang for our buck, as it were. And we realized that really our best exits were coming from these tier 2 cities, these tier 2 markets that were outside the valley. So you mentioned at the intro, Dollar Shave Club. I invested in Dollar Shave Club when they were still in an incubator in Venice, California in 2012, 2013, I think. I invested in Jet.com when they were in Hoboken, New Jersey, and my partner invested in Casper when it was still in the dorm room at University of Texas in Austin. So we were finding these opportunities in these far-flung markets. We had a unique currency that we were winning deals in these markets because we had all the relationships with all the Silicon Valley top-tier funds, all the strategic partners, all the corporates. And what we realized was as you go into these smaller ecosystems, the venture that is there, if there's any venture there, it tends, even if they're very good investors, they tend not to have very deep footprint in the Valley and in other sort of top VC hubs. And so the real challenge is how do you get your local company scale beyond Portland, beyond Milwaukee, beyond Nashville, if you don't have a way to bridge that gap? We realized we were that gap. So that was a big sort of epiphany for us. I think the third thing was this was all happening at a time when you had this remote workforce collaboration revolution happening. You had many, many more startups that were spinning up that were distributed day one, right? They had a small sales and marketing office in San Francisco, but they had all their development in the Ukraine. They had a call center in Kansas City, whatever it was. You saw more companies looking like this than ever before. And for us, we realized that geography was becoming a lot less important than it was 10 or 15 years ago, right? The notion of you have to invest within an hour drive of your office as a VC, that was going away pretty quickly. So we realized that was a major shift in venture and in technology. And finally, this was all happening at a time when the big legacy funds, as I alluded to, were generally going on and raising larger and larger vehicles. And as such, we're moving a little bit later stage. And we're really leaning on their best relationships with firms such as ours that had proven to be really good feeder funds for their platforms. And so we realized that as those relationships were developing, we had ways to really work with the best firms as we found companies super early that had tremendous promise.
You were doing this all before the pandemic and really the remote first workplace was taking hold to think outside the Silicon Valley box. But how has the pandemic affected your views since then?
It's incredible. I mean, the pandemic has really poured gasoline on a lot of the themes that we were, sort of hinting at and noodling at, several years ago. And I'll be honest with you, we have a lot of experience. I remember when we were first sitting down with LPs and sort of just kind of kicking the idea around and getting some feedback. And, we had people that got it right away and said, this makes total sense. We want to work with you. We had some LPs go, yeah, it's interesting, but, quite frankly, Silicon Valley has been very good to us. We're happy with the way we are. We're happy with the managers that we're working with. We'll track you and we'll see where you go going forward. Fast forward to March of last year and the pandemic came into full force. Quite a few of those LPs reached out in the last year and said, hey, are you guys still raising? A lot of what you said kind of played out. So it's been an interesting shift, but I would say for the most part, a lot of the things that we kind of felt was happening, the ground shifting beneath us, has really just accelerated in the wake of the pandemic, certainly in terms of distributed work.
Well, let's double click on the conversations you've been having with LPs. So there's over 400 VC funds currently in the market, and LPs are obviously overwhelmed with choice. So when you were meeting with LPs, how did you define your differentiability to stand out from the crowd? And what can other funds learn from your experience?
I think for us, and there's sort of an implied bit of advice for emerging managers that may be listening in. I think what we did right early on is we really handled the big, hairy existential questions first. Long before we sat down with LPs, long before we put together pitch decks and began marketing, we sort of, as partners, sat around a conference table for weeks and months, really kind of figuring out, why do we exist? What are we doing? Why are we going to be successful? What do we have to say? What do we have to bring to the ecosystem? And let's get that right. Let's get that bulletproof way before we start sitting down with LPs. So I think for us to get really clear about what your mission is, and then around that, making sure you understand what kind of brand are you going to build and how are you going to be congruent with your brand? How are you going to define yourself? Because to your point, Matt, you've got hundreds and hundreds of managers out there, pitching funds right now. And so how are you going to rise above the din in this marketplace? For us, we said, look, this is what we do. If you go to our website, if you go to any piece of collateral that we put out, it's all very clear. This is what Catapult does, right? We are focused on overlooked talent from underserved technology geographies outside the Valley. We help them scale. That's what we do. It's pretty clear. And either you get it as an LP or you don't, and that's perfectly fine. But I think one thing that helped us is that we were really early with that in messaging that to our LPs and making sure that everything we did was really congruent with that messaging. So I would say that to emerging managers out there is just really clear why you're doing this, what you have to offer the community, how you can uniquely win, and make sure you're communicating that in every touch point.
It sounds like a clearly defined edge, and edge is a very loose term, but you really honed in on like the messaging and how the differentiators are built into your strategy and the data execution you have to like gather information on these, far-flung markets that people weren't focused on, so that when those questions were asked by LPs, you had the information to back it up. You've learned a lot, obviously, but what do you wish you would have known when you raised your first fund that you obviously know now?
Throw out the rule book in some ways. What I mean by that is I think there are certain things, certain belief systems in raising a new fund that some managers assume this is the way we have to do things. And I think that's not necessarily true. What I mean by that is, getting stuck on the idea of, we have to have 50% of the fund raised for the first close, and we've got to get the anchor to do this. And, a lot of that doesn't matter anymore. I mean, it's really raise capital, put money to work, get to a close, Don't worry about rolling closes. Don't worry about optics. There was a time maybe 15 years ago or more where, let's say you raised a $50 million fund and you only closed on 4. Oh my God, terrible optics, right? It's going to hurt your fundraising. I don't think it matters anymore. Investors want to see that you're putting money to work against the thesis that you're raising money for, and that you can execute on that. And I think you build momentum however you need to, right? I know a number of funds personally that are out in market today, and they're raising like every $1 million or $2 million, they're closing. Then they're closing another $1 million or $2 million, and they're closing. And it's hand-to-hand combat. It is not sexy. It may not make the best TechCrunch piece about your fund, but guess what? You're in market. You're putting capital to work. You're building your brand. And so a lot of those notions around all the minutiae, what I need to do to get to closes, I think a lot of that has gone by the wayside, and I think it's really democratized the asset class.
Yeah, I couldn't agree more. I mean, for our fund, when the money was coming, you took it. When the money wasn't there, we were still raising and trying to push for closes and also investing at the same time. You can't confine yourself to like that one and final close kind of thing. It has to be fluid if you want to stay in the game and be investing, or else you won't even see deal flow as well, because people think you're so focused on fundraising, you're not ready to actually make investments. And you got to have to wear both sides of it very well, especially as an emerging manager. At least that's what I've learned.
Yeah, 100%. And one of the things I tell emerging managers, and look, there's a lot of people attracted to the asset class. It has a certain glamour profession sheen to it. I get that. But look, there's a lot of blocking and tackling. There's a lot of things about it that are not sexy. Fundraising, quite frankly, never stops. You are always raising, whether you're actively closing on a fund or you're just connecting with LPs. And so I'm sure, like a lot of managers, when I get on a plane, obviously pandemic makes it hard, but when I normally live on the planes, which I typically do, when I go to Chicago, when I go to Seattle, when I go to London, when I go to Paris, I have a list of folks that I'm going to reach out to who, are not investors, but we've been talking and they know about us. And it's a way to build a brand, to connect with those LPs, to continue to tell the story. And, it's just part of my job. It is going to be part of my job as long as I'm, at this firm. I happen to love it, and I enjoy that because it's a way for me to really have a barometer on what people are doing and thinking about and all that sort of thing. But I think there are some people that may be attracted to being a venture investor that don't realize the administrative burdens and challenges that you have to take on to run a fund. It isn't just meeting with founders. It isn't just writing checks. It isn't just the fun stuff. It's also the blocking and tackling, the building the brand, the recruiting, the developing the culture of the firm that you want to develop, making sure all those things work. It's a lot of long hours. So you just be ready for it because it's part of what we're doing.
Yep. As I told my wife when I started this, I'm going to be doing this for at least 25 years. So hold on to your hats. It's going to be a lot of work, but it'll be a lot of fun too. So you've been doing the emerging tech hub investing for a while, and Silicon Valley is, slowly catching up to it. But you've probably seen a lot over the time you've been investing in these emerging tech hubs, at least to give enough good advice to the governments and the LPs and the angel investors in these emerging tech hubs. What have you seen that they should pay attention to? What do you suggest that they, stay away from? What kind of advice do you have for these emerging tech hub players, like the governments and LPs and so on?
Yeah. So, I think you're absolutely right. What's exciting about this time that we're investing, and certainly from where I sit as somebody who travels around the world and meeting with governments all the time, really understanding what they're after, what they're solving for. It's very important for them to be involved and to take an active role in spurring innovation, creating the ecosystem that's attractive for founders, it's attractive for other people to be in that ecosystem, to really enable it to become significant and important going forward. And so a lot of what I do is I sit down and I meet with a lot of these government officials and try to understand what they've been doing, what's been working, what hasn't been working, what can they leverage. And I think, there are certain fundamental things I think it's very important, which is, can you create an environment here from an infrastructure perspective that's right for startups to blossom? In other words, if you're not in the U.S., right, one of the biggest challenges for many, many years in some countries, specifically in Europe, was maybe their bankruptcy laws were kind of not very founder friendly or startup friendly. What about their labor laws? What about other types of infrastructure and regulatory environment that was a disadvantage for investors to be there? Non-disclosure laws, another big one, NDAs, all those sorts of things. So that's an opportunity for some governments and municipalities to look at those areas and say, are these impediments for us to building a vibrant startup ecosystem? And I think the other thing is, in terms of making sure that you're incentivizing the right things. I think one mistake that I've seen government sovereign wealth funds do because typically sovereign wealth funds and governments are interested in economic growth and job creation for their local market. But sometimes what they'll do is they'll just deploy capital locally in local VCs, or they'll sort of put people in business to be local VCs in their market. The problem is, at some point, you've got to break out of your local market if you're going to build companies that are going to be global, right? And so, if you are in somewhere in the Middle East and you are a small Middle Eastern country, you can put lots of government money and put up 50 local VCs in your market. But what they'll end up doing is basically just recycling the same deals among them and driving up the valuations, and none of those companies are going to exit, right? At some point, you've got to build a bridge to well-known investors in Silicon Valley, in New York, in Boston, who are going to look at those companies and take a serious interest in that ecosystem, so that one of those companies that will break out of that country or that geography will become the Salesforce, the Google, the Yahoo of that ecosystem. And that creates the multiplier effect, right? That creates the job creation, the economic growth, the sort of PayPal mafia dynamics that you want, because it's the catalyst for the next generation of great companies to come out of the ecosystem, right? Once you have one big win, then you create an environment where people begin to say, hey, this is a great place to start a business. Look at all the examples I have now of successful founders that came out of this small corner of the globe, where the idea of being a startup investor here, a startup entrepreneur, was unthinkable 10 years ago. So I do a lot of that, is really understanding how each ecosystem can leverage their unique assets to become a magnet for startup innovation.
No, those are great insights. It's kind of like the Shopify ecosystem that has come out of Canada over the last couple of years. I guess I wonder, though, with the pandemic now and people doing the remote first thing, if founders are even willing to take government money with that stipulation, or VC funds take the money with that government stipulation that jobs have to be created locally if you're finding the best efficient talent elsewhere. You can be incorporated in Toronto or Canada and you can hire everyone else remotely. And therefore there are no jobs being created here, but the CEO lives here, something like that. How do you get around that?
It's tough. I won't lie to you. And we're in discussions now with some LPs that, initially came to us and says, we want to do this. We'll anchor a whole fund to do this with you guys. Oh, by the way, every deal you fund needs to be from this ecosystem, or 70% needs to be in the ecosystem. And so we sort of tried to walk them back from that mandate and say, look, we obviously are going to make the best efforts to make sure that every dollar is going to recycle back in your economy. But look at the bigger picture here, right? We want to make sure, for our fund to be successful, we want to back great companies that have great outcomes, right? There's no point in us deploying all this capital into subpar companies just because they happen to be in your backyard, right? That's a very short-term approach. The fund won't be successful. We may not raise another one because the performance won't be as good as we'd like it to be, because we ended up backing the wrong horses. That's not going to help you. It's not going to help us. And so I think there is a discussion that needs to take place with the manager and the LP, whether that LP is a sovereign wealth fund or government agency or whoever it is, to say, look, what is the long-term objective here? Probably the long-term objective here is to create an ecosystem that becomes a magnet for startup innovation for decades, not just a couple of years of job growth and job creation. That means we have to have a longer vision, and we need to be aligned around that. And maybe ring fencing our capital, in other words, saying all of our dollars have got to go into this particular ecosystem, is not the best way to get there. There's a balance there where we can say, okay, maybe 20% goes into, the ecosystem, but maybe the other percentage goes into companies that have an interest in the ecosystem. Or maybe they'll open an office here, or maybe they'll do some hiring here, or maybe they will re-domicile here within 5 years. Whatever the issues are, try to come to some other vision that ultimately caters to and delivers on the long-term possibilities here.
Yeah, it sounds like flexibility really needs to be at the core of the discussion when it comes to these golden handcuffs that investors are trying to put on funds or companies when they're taking their money. But let's talk about the long-term vision for you and Catapult. What does the firm look like in the next 5 years? What's next for you guys?
Yeah, I mean, we're building a generational firm, right? We really are. That's always been interesting for us. Like you mentioned earlier, we came out of well-known platforms. We could have easily stayed there and sort of ridden off into the sunset and had a perfectly fine career. We did this because we saw a vision. We saw a significant market dislocation that we had a unique way of solving for. And so that was enough, that was compelling enough for us to spin out and form the group. I think what we're going to be doing, and we're already kind of putting the blocking and tackling in front of us, is really building a constellation of funds over the next 6 to 10 years, all working around the same thesis, but in a way that supports it in a global way. So what I mean by that is we're still on Fund One. We're a new platform, right? We don't want to boil the ocean on Fund One. As much as I think there's some super exciting things happening in Jakarta, in Tbilisi, in other parts of the world, we're not going to really be in a position to invest there in the model that we have, which is a hub and spoke strategy with our Fund One. It's just a little bit too ambitious. However, what we do see happening is partnering with either local investors or global investors who believe in the vision of what we're doing so that we will have a MENA fund. We will have an Eastern European fund or focused on the Caucasus. We will have a fund in sub-Saharan Africa that really focuses on those ecosystems, all taking the same brand and the same approach, which again is a fund that is essentially based in Silicon Valley because that's where all of our business relationships have been for 20 years, but using a seed scout network where we have boots on the ground in every geography in which we invest. And so if we invest in Nashville, it's because we have somebody in Nashville. If we invest in Portland, same thing. We don't do remote investing. We do investing where we can leverage the strengths of what we have as a platform in our relationships, but we have people that are providing us the day-to-day mentorship to our companies in those ecosystems. And that's going to take time. But I think over the next, as I said, 5 to 10 years, we probably have 3 or 4 funds up and running that will give us a truly global reach.
Incredible. Love the vision and love how you're slowly taking over the VC world globally. So let's move into my favorite part of the conversation, which are your book recommendations. And you have a couple great books here that you'd like to share with the audience. Yeah,
I mean, you asked about a few books, and I sort of racked my brain, and I'm a bit of a book nerd. I love to read, and I think it's a great way to really constantly push your levels of knowledge and experience and insight. But I say the 3 books that sort of pop out to me that I end up either gifting a lot or I tend to return to again and again. I'd say the first one is Meditations, which is obviously the classic, Marcus Aurelius diary. I find it just a great treatise on leadership. It was a book that was, if you're not familiar with it, it was written for no one but himself. It was his personal diary. He didn't expect anybody would ever read it. And you really see an emperor struggling with internal battles, ethical dilemmas, things about leadership that I think is timeless. So in that sense, it's a classic. As I said, it's a book I gift probably more than any other, and it's one I return to quite often for guidance and for wisdom. So I think that's one that I always love to recommend. A more recent book I would say that I read recently that I enjoyed was Nassim Taleb's Skin in the Game, which is he's always a fun reader, a fun author rather to read. He's controversial. He's a bit of a polemicist, but I like it. He's certainly an interesting guy. But he gets out there. He slays sacred cows. He pokes bears. He really talks about the asymmetry of risk and how that can be corrected. He talks about how minorities in any group, in any ecosystem can essentially stymie innovation and real progress and ultimately rule the world. And here's a lot of sort of economic principles that have real world applications in business and in relationships. And I thought that was a really interesting read. Then the third thing is more of a startup related book called The Messy Middle, which is written recently by Scott Belsky. And Scott is a, multi-serial entrepreneur, venture partner at Benchmark, really interesting guy, very well, a very articulate writer, really enjoyed his writing. And what I loved about the book is, like the title would imply, it's really about the hard truth of building great companies, right? It's not about the start when everything is shiny and new and sexy and exciting and everybody's got, rose-colored glasses on about what it takes to build a company. And it's not about the end. It's about all the execution that is critical in that messy middle, right? It's about execution. It's about what it means to motivate teams, what it means to build the right culture. And I find so many parallels in that book for my experience in running 3 or 4 companies now, and obviously in building Catapult, and also the issues that I hear from my founders on a regular basis, the things that they call me at night on a Sunday night at 10:30, really, really worried about, like those types of things that don't make it in the glossy headlines, but it's really about what it takes to be a great entrepreneur and build a company and what you're facing. So those are the 3 books that I always like to think about and recommend when I'm asked.
No, those are great books and incredible suggestions. They cover both personal and professional development. And thank you so much for sharing those with us. And thanks for joining me in the tank today to discuss the Series A gap and the rise of seed stage investing with Jonathan Tower at Catapult.
Thanks, Matt. It's great to be here.
Thanks for listening. To learn more about Jonathan Tower, you can check him out on Twitter at Jonathan_Tower or catapultvc.com, as well as Jonathan's blog post on Medium. As always, if you enjoyed this episode, please leave a review on Apple, Spotify, or wherever you listen to your podcast. And make sure to give me a follow on Twitter or Clubhouse if you want to be in the audience and ask a question on our next Tank Talk. Till next time.